right. Welcome everyone to the first of our three-part series on mergers and acquisition bootcamp. We're so excited to bring you these exciting topics today, and just want to remind everyone that we do have two more sessions coming up. We have the post-close and audit readiness session on June 1st, and we also have a sell-side diligence and go-to-market strategy on June 21st. So if today's topic doesn't quite hit what you're looking for, there's two more opportunities to listen in and hear some exciting things. So first, I'd like to cover a few housekeeping items. If you have any questions during the session, if you can use the Q&A box for any questions that you may have, we'll cover those both during the session, and if there's any that are unanswered, we'll follow up with responses to those. Additionally, the webinar is being recorded today, so if you have to jump off, or if you'd just like to re-listen to something again, we'll be sending that out after the session. With that, I would like to welcome, we've got Josh Suchi, who's a supervisor, and Ryan Turbis, who's a partner within our transaction advisory group from Boule. Myself, I guess I should introduce myself. I'm Brittany Hancock, an audit manager here at Boule. We've also got speaking leader today, Wade Johnson, who's a senior vice president of employee benefits, who will be speaking later today on behalf of USI Insurance Services. So with that, I'll turn it over to Josh and Ryan.
Thank you, Brittany and Josh. Let's have a great presentation today. So good luck. All right. So thank you everybody for attending this webinar. Hopefully we can have a little bit of an interactive session. So if you have questions, we do appreciate and hopefully get some of those. So first, I'll do a little bit of an overview on Boule and who we are, just real quickly to set a baseline. We're a top 110 firm across the nation, the 9th largest in Minnesota, and really think of Boule as your one-stop shop, ranging from audit and tax services to consulting all the way through wealth management. Kind of a whole transaction life cycle, as we'll get through an outline in this brief webinar today. We are a member of Prime Global, which allows us to have an international outreach. So we have clients, obviously in today's world, that have a number of business operations overseas, and Prime Global allows us to reach out to other CPA firms within those specific jurisdictions to allow us to serve our clients, even though they may be outside of the domestic US. Boule, over 30 partners, over 200 staff, and that may be a little bit higher now. We've been growing exponentially, which is a good problem to have. Overview from our offices, 3 in Minnesota, the Eden Prairie, Minneapolis, and the newly Mankato office. Naples, Florida for our snowbird clients. And every home office of every employee, or wherever people get internet, is the way that I like to look at it. So now focusing down a little bit more, so we have Boule, and then within that we have the Boule Transaction Group. The Boule Transaction Group is really a dedicated group of people that have specific niches, and we'll get into really what those are on the next slide. But the main areas are buy and sell side, financial due diligence, also known as quality of earnings, ESOP, very well known within the ESOP space, business valuations, and financial modeling. Okay, so the transaction group, what do we do? There's a number of things, and this is pretty much an all-inclusive list, but we'll get into some of the specifics of what they are. So today we're going to be focusing generally on the items on the left-hand side, the due diligence and deal support. So those items pertain to financial due diligence. So quality of earnings. I'm going to just set a baseline. What is a quality of earnings? Quality of earnings is not an audit. From time to time, we get that question. So quality of earnings is done under consulting standards. When we think about accountants, we think about what do we have to opine on, and this is under consulting standards. We try to get the quality of earnings as close to GAAP as possible, but obviously an audit is a different level of a test service. So I just wanted to set that baseline. Some of the things that we do as part of due diligence and deal support include, but are not limited to, the deal structuring and execution, which kind of is all throughout the transaction process. That can be pre-LOI. It can also be during the LOI if things change that came to light. Technical accounting and analysis. And this is where, having a CPA firm behind the Boule name and having a transaction group within that, we try to focus heavily on the technical side when we're going into a quality of earnings to get it as close to GAAP as we can, because hopefully there's a successful transaction and we can successfully transition it to our audit readiness group, which will be in the second session, as well as the recurring audit and tax work. So we truly try to flush out all of those differences during the due diligence as we can. And we'll get into specifics of how we do that here shortly. Included in our due diligence and deal support, we generally always include tax due diligence and structure. And when people think of tax due diligence, generally you think of SALT or state and local tax matters. In today's world, that can be a very hot topic, especially if you're considering a SaaS business. And we'll get into some more details on why. Then some of the other things that the transaction group does for services, as I mentioned earlier, is those listed on the right-hand side. Josh, do you want to kind of just walk us through on the next slide? What is a transaction life cycle when we, as a CPA, think about walking somebody through that whole process?
Yeah, no, thanks, Ryan. Thanks, Brittany. So you're kind of looking at kind of maybe potentially buying a business, whether it's kind of strategic or kind of owner operated, PE, kind of search fund. There's kind of five main phases kind of from an accounting kind of standpoint. You got kind of your acquisition phase, which is kind of pre-LOI, kind of maybe talking with management of the company, seeing if it's going to be a fit. You kind of get your acquisition kind of support. This is kind of post-LOI, your financial due diligence, your tax due diligence, kind of the meat and potatoes of kind of the quality of earnings. And that's kind of, those are the kind of the two areas we're going to kind of focus on today. And then once you've successfully closed your deal, you'll go into kind of the post-close accounting matters, your kind of flow of funds, the opening balance sheet, the working capital true ups, those kind of matters. From there, kind of your annual kind of tax work, audit work. And then as you kind of come to looking to exit, kind of buy side or sell side, kind of M&A.
Yeah. Go ahead.
Go ahead.
From a LOI perspective, we always get the question, sometimes clients are hesitant to engage a service provider because they insinuate that fees are going to start to be incurred. So when should a potential buyer of a business, or seller for that matter, engage in discussions with their attorney and CPA on the LOI?
Yeah, great question. We recommend kind of as you're starting to have those conversations of potentially selling or potentially buying, have that kind of loop us in. It'll help with the LOI from a scheduling standpoint. If you are going to be looking for a buy side, we're looking to schedule maybe 4 to 5 weeks out, kind of once we get a signed engagement letter, which is traditionally right around the time that you're getting a signed LOI. So kind of that helps with the planning side. It helps with us. We can ask some questions, just general, like, are they filing sales tax? So you can maybe ask that question if you haven't asked that question already. That'll help maybe iron out or maybe bring to light some issues that we might find in diligence right away. A high level, another item that's kind of good to have a general understanding of is rev rec. How are they recognizing revenue? How are they billing revenue? Are they billing a bunch of stuff ahead of time? That might lead to some issues kind of when we come into the financial diligence side. The last kind of bigger item that you want to kind of get comfortable with in that kind of acquisition phase, kind of doing your business diligence, is the seller's management add backs. If they're a smaller business and he's running, some of his personal expenses through, I took a trip with my family and it was one day of an event and then 6 days of some personal vacation. Getting comfortable with your arms around that, or a salary, they're paying themselves to kind of maybe above market salary, getting your arms around that and you're kind of getting comfortable with that early on in the process kind of helps, kind of in that acquisition phase, or the acquisition phase, kind of when you move to your acquisition support. We'll kind of talk more about this in detail on the next slide, but really broad level, that's your quality of earnings, your net working capital analysis, the state analysis, or the tax analysis, federal and state, and SALT, and kind of debt, kind of those kind of other items.
And when we think about the life cycle and how long this process typically takes, so when I think about a standard LOI, let's just, the ones that we typically see is 90 days, right? So you have 90 days exclusivity period to hopefully negotiate final purchase documents and close on the business. How long, Josh, is our typical due diligence process? And at where in that 90-day cycle do we typically come in? I know LOI, you said they need to reach out to us immediately so we can get the request list and high level understanding of the business, get that done immediately. But then when are we really getting turned on?
Yeah. So let's kind of use that 90-day LOI. For example, first 30 days, traditionally is business kind of diligence. Kind of the next kind of 30 is kind of accounting diligence. And so that's kind of where we would get slotted in, kind of that middle third of the LOI, that signed LOI exclusivity period. We're traditionally if a typical kind of 2 to 3 reporting periods, we're kind of looking at a total kind of start to end of a 4 to kind of 6 weeks, with kind of that workbook kind of ranging in that 3 to 4 weeks. And then that written report after that, maybe a week or 2 after that. Kind of timing depends on, what we're finding, the cleanliness of the accounting, and that will be communicated kind of throughout the process of, hey, if we're starting to see a lot of adjustments and that's going to take some more time on our side, letting them, we reach out and let you know that, this might drag out a little bit because of X, Y, and Z. And maybe there's pushback on the target to maybe have them do some of the legwork as well. So it kind of that 4 to 6 kind of week kind of time frame, I think is a fair estimate kind of from a high level.
Awesome. Thank you. So I think, Brittany, let's jump to the next slide and we'll get into, we're going to spend quite a bit of time on this slide. Quite frankly, there could be a series of webinars on each of these individually, probably. So we're gonna go through some examples of the major components of that quality of earnings. And Josh, I think you're gonna start with really the Q of E, and then I'll take the net working capital and debt link.
Yep. So the first maybe misconception about a quality of earnings is there's not a standard set in GAAP that, hey, this is what we need to do for a quality of earnings, which is kind of nice. You can kind of scale your quality of earnings to your deal size. If you have a bigger deal, you can do more testing. You can look deeper at certain areas. If you have a smaller deal and you're really just looking at EBITDA and want to get an understanding of kind of expense and revenue recognition, you can do that. A lot of that, as kind of Ryan mentioned earlier, kind of that small to lower middle market that we kind of play in. Traditionally, we'll see a lot of closely held businesses with maybe no audit or review, or kind of third party looking at the financial statements on an annual basis. Potentially the bookkeepers, the owner's spouse, or brother or sister, or somebody that they're helping with limited accounting experience, or even they're just trying to they do their own books, and it's just to minimize tax liability as much as possible. We kind of see it all. The quality of earnings really helps kind of normalize those earnings to see, how would a bank look at them? How would investors look at them? Kind of that third party institution, how would they look at them? We're traditionally kind of looking at monthly periods over a 2 or a 3-year reporting period. The trailing 12 months, which would be the last 12 months, or TTM period, as it's kind of commonly referred to, and then either the last fiscal year or the last 2 fiscal years. The kind of when we start diving into the kind of a typical quality of earnings, kind of our first kind of trying to get our arms around is what's reported EBITDA, and then kind of validating the seller's add backs. Most of the time, that's kind of how the LOI is kind of an evaluation is formed based off of kind of the reported EBITDA and the management add backs. We're trying to get comfortable with those two right away. From there, we kind of will move on to kind of diving into various kind of aspects of the income statement. Really looking at revenue. How is it historically been recognized? Are we billing annual memberships and recognizing that all in a month, the month that we bill it? Kind of looking at what's the practices, how it should be done. Maybe looking at some customer contracts, picking some examples of some invoices and contracts to read through, make sure that the contract and recognition and invoice kind of all mesh. Looking at customer mixes. Do we have a large concentration with one customer? Do we have, looking at revenue mix, is it recurring versus non-recurring? In a lot of SaaS deals, you'll see the term ARR, or annual recurring revenue, used. And sometimes that's an alternative approach to valuing a company. And is that kind of in line with where we think it will be? Kind of looking at the revenue, customer, and mix. And then from there, kind of moving on to more the expense side, getting our arms around, we're using W-2 employees or 1099 contractors, tying out what we've reported on our W-2 and our 1099s to the financial statements to make sure that we've kind of calculated anything or we've properly reported those to the right authorities. And then looking at maybe some supplier contracts, seeing if there's, if we're purchasing inventory, seeing if there's any minimum quantities that we have to be purchasing in a given period. Employee contracts, kind of other lease agreements, kind of other kind of third-party agreements that might be running through your income statement. And then one of the big kind of the tests that we'll kind of do is called a proof of cash, where we kind of look at the ins and outs on the cash on the bank statements and reconcile them to the financial statements and make sure that what's being reported on the bank statements is actually running through the financials. And we'll do this normally the last 12 months and make sure that that kind of reconciles within the 1%, which is kind of the standard kind of standard level that we're kind of looking for there.
Josh, can you just, nice job kind of summarizing that. There's a lot to chew on there.
Yep.
But can you just walk through, you had a very unique experience with a specific diligence. We're on the buy side, and under LOI, we're getting going on the due diligence. And there was something that came up in one of those customer contracts that I thought was pretty unique. Can you just talk through what that was?
Yeah, no, we working through diligence, kind of getting to a later stage workbook, kind of maybe that end of week 3, early week 4 kind of time frame. And we'll have kind of read through some of the contracts. In one of the major kind of customer contracts, there was a clause in there that basically gave their top customer the right to purchase, the first right of refusal to purchase the business. So now that deal's kind of on hold as they give that entity the first right of refusal. So that's kind of one thing, kind of when you kind of read through these contracts, you can find kind of very unique things like that might not have been disclosed to the buyer kind of throughout the process.
Awesome. Thank you. Just a reminder, if you guys do have any questions, by all means, you can put them in the Q&A and Brittany will direct them our way. So those are highly encouraged and appreciated. So what Josh talked about is really normalizing the free cash flow of the business. Okay. And as we're tweaking those numbers from an income statement perspective, those have to get flushed through traditionally the balance sheet. Okay. So the balance sheet is where we're going to talk about net working capital. So first, I'm going to just give a baseline on what is net working capital. Net working capital in a due diligence or a transaction, generally you're looking at net working capital from a debt and cash-free perspective. Meaning, if you take the current assets of your business, you think about your balance sheet of the business, you take out the cash, you keep in accounts receivable. If there's some other current liabilities that are business related, you include those, as well as traditionally like prepaid expenses. That would kind of comprise your current assets. On the liabilities side, those things are generally your accounts payable, accrued expenses, which can include accrued PTO, compensation, sales tax payable, etc. Taking the net impact of those assets and liabilities is what we think about as normalized net working capital on a debt cash-free basis. Okay, so net working capital in general, I always tell people that it's probably the least understood and one of the more complex areas of the business, specifically when we think about the transaction sizes and who we're traditionally dealing with. As Josh mentioned, many of these sellers are likely on the cash basis. They were a successful entrepreneur. They may or may not understand what net working capital is. So sometimes we have to educate them on what is net working capital. Because if we are buying the assets of a business, which generally we see asset purchases, we do see stock purchases from time to time, which can be tax driven or assignability of contracts driven. But generally, in an asset purchase, you're buying the business at a certain point in time. Okay, and as a buyer, you're going to want net working capital in the business on day one, so you can continue to operate the business effectively. From time to time, we come across sellers that, even though it's defined in the LOI as we're going to buy a normalized amount of net working capital, all of a sudden we get later on in diligence and they communicate to the buyer that, well, what do you mean I don't get to keep my accounts receivable? I thought I get to keep all that cash. No, not really. So those are some hurdles that we have. So I'm going to get into some specifics on certain things that we look at within net working capital to help us normalize it and how it can impact the purchase price, for instance. So when you think about your balance sheet, let's think about accounts receivable. Things to be concerned about from a buy side on accounts receivable. Obviously, the revenue recognition would tie in materially with this, as Josh mentioned. Some other things with accounts receivable that we want to be aware of is, are my customers generally nonprofits or government agencies, or just quite frankly larger businesses that you may have net 30 payment terms or due on demand, but they say, well, if you want to do business with me, I'm going to pay you in 60 days. You want to get an understanding of that, because it's going to impact you as the business owner post close. Are there any old accounts receivable that the target company, quite frankly, just has not followed up on? Do I even want to buy accounts receivable that are over 90 days? I don't want to pay for something if I'm not going to collect on it. Okay. Inventory. Inventory can be a very material negotiation item, and generally it comes down to like a slow moving analysis. So if inventory is a material part of the business, we want to get an understanding of how often are they counting inventory? Do they have cyclical counts? How are they thinking about a reserve? Do they have one? Likely not. How are they pricing their inventory? And the slow moving analysis, one thing that we generally look at is how many quantities of that item have you sold over the last year, 2 or 3 years? What excess do we have on hand compared to what we've sold? How are you deciding how many quantities to purchase when you're launching new products? Are we overbuying at that point, which is resulting in slow moving inventory a year later? Those are all specific things that we try to work through with the buyer and the seller on getting a normalized amount of inventory. Switching gears down to the balance sheet current liabilities section. Accounts payable, is it normal accounts payable within that, or are there credits, or are there payables that we're not paying for some reason? Are there disputes? Trying to get a normalized amount of that, as well as doing some audit type procedures on subsequent disbursements to make sure that they're recording their accounts payable in the proper period, to make sure that we're matching revenues and expenses appropriately. Accrued expenses, so most of the deals that we see generally do not have any sort of accruals on the books, and we are recreating them. So those are, when are they paying their employees? Can they track PTO? Sales tax, is that the right number on the balance sheet, or are they running all the payments through the income statement and the balance sheet liability continues to increase? Deferred revenue, if it's a SaaS business, is the deferred revenue comprised of generally just 1 month's worth of service? Is it quarterly or 6 months or annual contracts? Josh, any questions or additional comments on any of those areas before I transition into how and why that networking capital component impacts the transaction?
Yeah, I think maybe the only kind of piece, and you had mentioned deferred revenue. I think maybe one of the negotiation kind of pieces is including deferred revenue either kind of in working capital or identifying that as maybe a debt and debt-like item. We'll kind of come to that in a minute, but that's kind of one area that it can kind of flip-flop from transaction to transaction. In a lot of SaaS deals, we'll see it kind of more as debt and debt-like, and then we're trying to get some kind of dollar amount for that. But if it's, it's a smaller amount and it doesn't fluctuate much month to month, maybe we see that as part of the networking capital true up.
And Ryan, we did have a question come in on kind of how that deferred revenue is treated as part of that networking capital. Do you want to kind of touch on, for some of those areas where maybe during the acquisition process, you identify that, during that QAB, there is deferred revenue, and that is being, assumed as a liability? How does that impact that buyer's networking capital true up?
Yeah, so it's a great question. I'm glad we got one. Thank you for whoever asked that question. So it depends on the deal, right? So deferred revenue, I would look at it as a component of normalized networking capital. Okay, so generally what happens if it's a SaaS business, for instance, that deferred revenue number is going to cause, once you back out back to the debt-free, cash-free, you back off all the cash. Generally in a SaaS business, normalized networking capital is going to be negative. And that's due to generally the deferred revenue on the balance sheet. So the way that we think about that is that's okay. We're just trying to determine what the normalized peg is, but the deferred revenue number matters for negotiations, because as a buyer, I still have to likely perform services to fulfill that revenue. So as a buyer, I would prefer and desire to get cash left behind to cover my cost to service that deferred revenue. Okay. Now, what is that cost? So let's say you think about an income statement, you have revenue of $1 and you have hosting fees and support fees that are 15 cents. That cost to service that deferred revenue in this simple example is 15%. So the deferred revenue on the balance sheet, I would expect and hope that we could get 15% of that deferred revenue balance left behind in cash, because I still have to perform services on that deferred revenue. Okay, great question. So why does networking capital matter? So we go through this analysis on a monthly basis. We're looking at it from a month-end perspective. Generally, we're looking at what is a normalized amount of networking capital. So we're doing that historically, but then as we move further along in diligence, we try to say, well, when is closing going to happen, likely? And what is the networking capital likely going to be at that point in time? And here's why it can matter is if you have a seasonal business, okay, and they're busy during the summer and we're buying the business in the peak of the busy season. I don't necessarily want to take a trailing 12-month net working capital as a buyer, because that trailing 12-month average is going to be lower than my needs I may need on day one, because I'm at the busiest point in the year. If we're closing, on the 1st of the month or the 15th of the month, they may be sending all of their accounts receivable or paying all of their accounts payable on a specific day of the month. And we looked at net working capital as of the end of each month. Sometimes changing that closing date to any other time during the month can have a material impact on net working capital. So those are all things to consider.
Maybe another.
So, go ahead, Josh.
I was going to say another point on kind of why it matters. If you're in a growing business, it'd be more beneficial to the buyer to have a T3M, so a trailing 3-month average, rather than a T6M or 6-month average, or a 12-month average. As the business grows, working capital needs are going to grow, and you're going to want as closer as kind of a shorter time frame, because that's going to be more representation of the current business, especially if there's significant growth over the kind of the reporting periods.
So thank you, Josh. With that, Brittany, I think I touched base a little bit on the debt and debt-like items as far as pulling out the debt and cash-free type things. So I'd like to transition to the next slide, and we can just talk through why some deals expire, because I think this is valid here, and then we'll wrap up things here in the next few minutes and transition. So, Josh.
So the first kind of the big ones are kind of diligence findings, and kind of clarity of LOI, and sometimes clarity of LOI and kind of mismatch representation kind of go together. So maybe starting with those two, me and Ryan were on so as you're kind of walking through your LOI, it's very beneficial to make sure everyone's kind of on the same page, having a clear call out of how working capital is going to be calculated. And maybe it's not where you're going to use a T3 or T6, but saying, hey, we're going to determine it based on kind of how our CPA firm or how the due diligence firm is going to look at it, and using it some kind of average that we both agree upon. Having that language in there to start really helps. It doesn't necessarily mean that it's going to be that way. Me and Ryan were on a deal where they had language on that, but they had poor representation. They walked in and basically told them when they signed the LOI, they were going to get all the receivables. Basically, they were going to get the working capital. And when it kind of came to talking about setting a peg for working capital, they were very confused on why they weren't going to be getting the receivables. Almost backed away from the deal because of it. Our buyer had to kind of take back. Luckily, he still liked the business enough to kind of work a little bit on the working capital side, and kind of figured out another approach. But I think sometimes when you get that advisor, maybe they've been their tax accountant for 30 years and they're a really good tax accountant, but when it comes to selling a business, or they're really good with handling contract legal matters, but when it comes to helping on kind of the legal matters of selling a business, they're probably not as much experience in that. And I think having them, or kind of voicing that to the seller early on to find it, maybe it might be good for you to find somebody that kind of knows what you're doing. It makes the process go a lot smoother. There's no miscommunications or phone calls where we're trying to explain something that's somewhat of a common concept kind of in the M&A kind of realm, that they're just not kind of picking up. Ryan, you have anything to add on that?
Yeah, I'd say, just quickly, and then we'll wrap things up for our portion. The seller remorse side of things, that's obviously qualitative. The best way that I'd say you can try to mitigate that as best as possible is just get to know who the sellers are outside of the business. Both the buyer and the seller have a number of likely very qualified advisors behind them, and they're giving both respective parties advice. At the end of the day, it's willing buyer and willing seller. Just remember that the deal is between those two individuals or groups of individuals, and try not to let the advisors get between that and focus on the big picture. So get to know that seller over a period of time, and take them out to dinner, get to know their spouse and kids, and really just find something in common and connect with them. That generally helps a lot with these seller remorse horror stories where you're pretty much all done with everything, and at the last second they can't let go of their baby because they built it from scratch and it's just everything that they've ever known. So I think that kind of concludes everything that we touch base on. It's a very quick outline. We can go on and on for a number of things, but if you do have any follow-up questions, by all means, there's our contact information. Also on the Boule website under the transaction group. So without further ado, Brittany, we'll hand it back to you.
Well, thank you both, and so happy you were able to join us today for the session. Next up, we'll have Wade Johnson, Senior Vice President in Employee Benefits for USI Insurance Services. We'll be touching on employee benefit landmines that can arise during acquisitions. So with that, I'll pass it on to you, Wade.
Thank you, Brittany. I think the biggest thing I want to start off with is hopefully from listening to Ryan and Josh talk. I think the biggest advice I would give is something Ryan kind of finished with, which is finding partners that you can trust and work with people that understand the business and understand the unique piece of really what happens when you're trying to purchase a business. So my name is Wade Johnson. I'm a Senior Vice President with USI Insurance Services. I'm also a part of our national practice in the private equity space. And so unfortunately or fortunately, that means you learn a lot through trial and error after you see acquisitions and people, and the seller's remorse piece is such a wonderful way to position that, because it happens even on my side. I really only focus on the employee benefit portion of an acquisition, which is just a fraction of what Ryan and Josh's team does or do. But I think what I would tell you, I'm going to briefly talk. I only have about 15 minutes here to speak, but the first part is really what does an audit look like? I'm not going to go great into detail of what an audit is on my side, but what I would encourage you to do is to really realize that you have partners in your business. Use those partners. Hopefully they're people that you trust. In our case, where we're a benefits broker, for our clients, we do acquisition, due diligence, and audits on any potential purchase they're going to make. We don't do that at any cost. That's just because of the relationship we have with the companies that we work with. If you're a private equity group or someone that's investing that way, finding a benefits broker or a property casualty broker or someone like the transaction group within Boule, it's finding people that are experts and have gone through this and have understood kind of where the pitfalls might be or where those landmines might be. So Brittany, on the first step, I would just say that our first slide on the audit slide, it really is, we have a very deep process that we use. Oh, by the way, I tried to use some creative little things in my PowerPoint to make, to add some spice to my talk. So, this, I'm not going to go through an audit. This just shows you a brief explanation of this very large document we have. And what we have is a fraction of what the Boule group would go through when they do an audit, but it's really gathering information. And when Josh talked about the life cycle, you would really want to get your benefits broker involved at minimum in that second 30-day period. Just like you would the accounting group or your legal team is obviously going to be involved kind of day one. But benefits are oftentimes something that gets shoved to the last piece, unless you're working with someone like a Boule who understands kind of the importance of this. But it is such a unique piece, both from a financial and a compliance piece, which I'll talk about in a second. And the quicker you can engage us or your partner, the better you will be served. And you don't necessarily involve HR of the target company. This is very much a C-level to C-level conversation with the trusted people that you work with. So it's not involving other people, which I think is important, especially if you're a private business and you're looking at purchasing another private business. And the privacy piece is pertinent and important. So we go through an entire process where we're really going to ask for data, ask for information to do what we need to do on the financial and compliance part, and then talk through, here are some things to think through that you might not be thinking about when you're looking real high level at kind of the financial piece. If you go to the financial slide, which is the next slide, Brittany, again, you're going to be very excited by my little Zoom piece. There's a lot on here, and all of these probably come from different landmine examples where I've run into them. But the annual spend it seems simple. This is your accounting group, and Boule would help you with this part. But there are some things in the benefit world that people forget about. Things like payroll, enrollment systems. The world is changing so much as it relates to benefits that there are different vendors that are used that you might want to make sure they understand each part of that. It's not just the health insurance cost, which I think primarily what it has been historically. That goes to the financial liabilities piece. If you're targeting a smaller entity, you might assume that they're fully insured on their benefits. Being self-funded is something that more and more employers are doing, even at a smaller scope. That creates different liabilities when you terminate contracts or when you make an acquisition in target companies. So it's understanding what that liability is. And that also talks about when is their renewal. It's something that both Josh and Ryan talked about is timing. Everyone just assumes that renewals for health insurance tend to be January 1st. That's only about 70% of our book of business. So that means 30% of the time, your health insurance spend might increase 10, 20%, depending on how poor the renewal is. And you need to understand what that looks like when you're doing your financial analysis. So knowing that timing, and maybe they already know, maybe the target company knows what the renewal looks like or feels like. Otherwise, you can share their data if they're willing to give it with someone like us to do that kind of projection to see what does this feel like, what do we expect. But again, health insurance, unfortunately, for many companies is becoming probably the second biggest line item on the balance sheet, depending on inventory and industry. But so that if that's going to go up a significant percent, it can impact the profitability of the business. IBNR claims, if you're self-funded, those are the incurred but not reported claims in a self-funded arrangement. You might have a big claim that's looming out there, hasn't been paid yet, and depending again on the closing date of your acquisition, that can be impacted there as well. So just things like that to really be aware of. Benchmarking, I'll talk a little bit more about that in a later slide actually, but separate or blended benefits is another piece to think about. When you're in the middle and in the throes of these acquisitions and you're talking to legal teams and accountants and both sides are kind of negotiating things, the benefit side of things can often be left to the side, or it's not again kind of the primary focus of the business. However, one thing to know is that we often succeed in when there's an acquisition made of saying, do not necessarily take all the employees and move them onto your benefit plan. There are benefits to doing both, but sometimes it is better to say, let's keep the benefit plans up and running alongside if you're the purchasing company. Keep those benefits separate. Let's deal with that at a later date of trying to kind of merge the two together. There are benefits, pros and cons to doing it. So you just want to walk through that so you understand the timing. Contractual, this is something that, again, I think it was Ryan that mentioned, but more so recently in the deals that we've done, you see things where wellness companies or payroll companies or enrollment systems have termination charges on their annual contracts or multi-year contracts. And again, those are things depending on what kind of acquisition you're making, stock or asset, where those are going to be things that might not be on the balance sheet because no one expects to pay them. But again, that's part of where someone like the transaction group is going to work alongside someone like myself to look through those kind of contracts, make sure there aren't little pieces that are going to miss or be missing. The next piece is compliance, and again, in the interest of time, I could spend all day on compliance. This is a really exciting one. I don't even know what this is called, but hopefully it gets there. There we go. I will tell a story or two. I do think it helps a lot to I think both Josh and Ryan shared examples, and compliance is becoming kind of the nemesis of employee benefits, I would say. And 5500 filing is very simple. A lot of employers, though, don't understand when they have to file them, especially smaller organizations that maybe aren't using the full power of an accounting firm, a CPA firm. Again, I think Josh said they might have an accountant that they've been working with for 20, 30, 40, 50 years, who's really good at doing the accounting and doing the books from a business perspective, but doesn't always understand some of the implications with the federal government and when you need to do that. A company might have grown to have over 100 employees or over 50 employees, and that kicks certain things in. And we've had deals not fall through, but where there's had to be financial compensation to back file, things like that. Same goes for discrimination testing. But the one that I would really talk about is the Affordable Care Act. We had a target company, or a company that was a client that had a target company that when we did our due diligence, we found out that they were not offering health insurance to a certain group of employees. And they did that on purpose. They did that with intent. But the financial potential penalties that could be accepted by the purchasing company, they were so great because of the way the Affordable Care Act came out and what those regs said, that it actually would eat up about 60% of the profit of the company. And the margin just wasn't there. It actually killed the deal, which was sad, because that was, there was ways around that. And it had the target company kind of done some pretty simple things, they could have avoided it without a huge cash outlay. But that's a realistic example of where compliance came in and actually blew up an entire deal. And it was the last thing. And we were pretty late in the game on that one. And so they had us do the due diligence and rip through all these things. And we got all the documents and started doing some of the affordability testing. We found out that this was going to be a problem. FML and leave management, I guess I'll talk about this as it relates to just another thing people don't always think about or perceive, is the fact that right now, parental leave and leave management is becoming a really big deal, as many of you know, or disability or time off. Every state is kind of going through their own legislation around that. Federal government may or may not step in eventually, but right now there are certain states that have actually county by county laws and rules about what sort of leave must be offered. And if you're buying a company, it depends on where the employee lives, not where your site is or where business is done. And so you might walk into an acquisition where they have one salesperson in the state of Virginia, and in Virginia they go county by county on the leave laws. And so how are you going to manage that? And so there's just a lot of pieces that you just want to know, because you don't want to walk into that obviously blind when you're talking about the profitability of a company, the sale. You want to keep just the machine moving, so to speak, and make it better. You don't want to create more work for your HR team or your administration. So things like that are big. The other piece, federal mandates, SPDs, SPCs, SPDs, SPCs, those are all, we love acronyms in the health insurance world, but those are all legal documents that need to be given to employees. And it's amazing to us how many smaller employers don't realize their financial or just their legal obligations in that case. So I really that's one of those things that we focus a lot on compliance. Again, finance and compliance are the two big ones. The next two pieces are just things that I would add as kind of things to think about. So if you move on to the next slide, Brittany, and we'll talk about key employee concerns.
Before we move on, Wade, I just wanted to touch on, we had a question that came through, and this might relate to both your and Ryan's presentations, but is the employee benefits due diligence required for all quality of earnings engagements?
Ryan, I'll let you take that one.
Yeah, I think it depends. So when I think about benefit diligence, obviously there's what Wade and his team would do, but from our perspective, I'd say something that we're looking at is there a union? Is that plan funded or underfunded or overfunded? And the other, I'd say big item is 1099s or independent contractors versus employees, and are they properly classified? And as Wade mentioned, the employee benefits can get specific to specific states and counties. It's the same thing on the contractor and salary and wage perspective. So I'd say very high level, a component of it is, but I'm not Wade and his team or a benefits attorney for that matter.
And I would just add that it does depend a little bit on usually around self-funded plans is really where you're going to get in deeper to that kind of financial obligation or asset management piece. And so if the funds are put into a trust, for example, where's that trust? Does that get assigned over? Things like that. Is there a piggy bank, so to speak, that people have? I mean, many smaller employers, even if they're self-funded, they just pay as you go. They don't necessarily book a budget or have a max funded plan or anything like that. So there are some things that could be, there are some what we call level funded plans where at the end of the year, you might get funds back if your plan ran better or things like that. That's then do you do a historical look back to say, is this something we should expect or not expect? And when do you get paid? And if you're really large or larger and you do what we call a prescription drug carve out, there are rebates that come in on a quarterly basis with a lag, and there's things like that. So there are a lot of pieces. It really depends. I would argue more on probably the funding mechanisms of the target company, on whether there should be any financial or how deep that financial analysis should go. Hopefully that answers that question. Certainly, if you want to reach out to us, either group, we can elaborate more on that, because it really probably depends a lot on the scenario of the target company. As far as this, I bring this up because, again, one of the things that I don't remember if it was Josh or Ryan that brought up, but you might have a key employee that is, let's say, the salesperson on the 5 largest clients of the target company. What happens from your financials if that employee leaves, or I'll even kind of say more morbid, is it disabled or passes away? And so there are pieces you can purchase: key person life insurance, key disability policies, to help with that. And separate employment contracts, I know that was something that Ryan brought up. I think it's very important as well, because some people in a really small organization, when a company was first founded, they oftentimes just make side deals on a napkin kind of thing, and we don't find out about it till later on, where someone might say, hey, we promised to pay this person's health insurance for 10 years after they retire. Well, there's some issues with that. You got to be careful from the legality perspective of it, from a discrimination piece, but also the cost. The cost for health insurance is one thing, but the claims that employee represents are a different discussion. And so, for example, let's say that this employee is 60 and has some medical issues. You might buy them health insurance or give them a financial, a payout to say, we're going to pay for their insurance for 5 years. This could go for owners as well. But we don't necessarily want them on your medical plan, because their claims all come with you, and that increases your financial obligation upon renewal. So there's a lot around that, and health insurance is often a big piece of an exit, contract with a employee, whether it's a key employee or an owner. So just be aware of that, and it doesn't mean you can't do it. Just understand both the legality piece, but more importantly, the financial implications of that, because it's something that often people don't think. They look at the premium on their medical plan and say, oh, well, who cares? We'll pay that, $500 a month for that person. But what you're not really thinking about is what the larger impact of that claim might be when the renewal is done. So it's better to just write them a check for $500 a month for 3 years, or whatever however you want to phrase it. Get them an individual plan or something like that. And there's a lot of conversation that goes around that. So just be aware of that. I think that's a big piece. And the last piece, because I'm running up against time, is employee disruption. This is something that we did not talk as much about 2 or 3 years ago, but it is becoming, I think, so important in this area where people are really fighting for talent. When a company is purchased, there is a lot of disruption, and oftentimes you can have employees that now are looking elsewhere because the owner was the person they trusted. They've worked with them for 20 years. Everyone is fighting for talent in the talent pool right now. And so what can you do to keep the business as profitable as it has been when Ryan and Josh and their team do all their magic on the math to say, what's the profitability? What can we do to make this company grow, or at least continue to make money? Well, if you lose employees, how does that impact that? Now, some of the turnover might happen anyway. Right now, in this day and age, unfortunately, I think we're all seeing that. But this goes to things like, do we want to have to maintain that separate benefit plan of that target company? What does that feel like? What does it look like? Let's do benchmarking to show our benefits versus their benefits, which is a better plan. It can help to, for lack of better words, sell the transition to the key employees to say, hey, you know what, we offer a better disability plan, or we offer vision insurance, or whatever it might be. And now is the time to look at some of those things, because you're going to see a per head cost, or a per employee, or a per member cost. So how do we look at that? And is there ways to get, bulk pricing when you're combining groups? Is there a benefit to that? So just be aware of that, because again, that's something that in some of the deals we've done recently, the target company had much richer benefits than the parent. And when that happened, they had some employees that, were either going to leave or threatened to leave, or they wanted an increase in their income to compensate for that, which would not be in a P&L or in any of the income information that, would be provided by the target company. So those are the pieces I think that I've seen that are really, that kind of cause next level stress that maybe you don't think about when you're first looking at a target company. You're looking at profitability and margin and that sort of thing. So again, a lot of the private equity groups right now are trying to do that comparison side-by-side benefit piece beforehand, and they're trying to make decisions on whether it's better to just, stay the course with the benefit plan, or do you want to do an additional deep dive on kind of a preemptive strike when it comes to those sorts of things. So I think those are all the things I really wanted to hit on. I think I'm close to my time. So if you have any questions, you can certainly reach out to us at any point. Brittany knows how to track us down. And again, it was great. I think it's great to see where Ryan and Josh and the USI team can we all kind of have our expertise, and finding those people you trust, I think, is the most important thing. So I'll just leave you with that.
Well, thank you, Wade. We'll stick around for just a couple minutes to see if any questions pop up in the Q&A, but otherwise, thank you everyone for attending today. And if you do have any other questions, feel free to reach out. You will be receiving a email with the link to rewatch the webinar. So yeah, feel free to reach out if you have any questions.